So we just want to start off by thanking everybody for coming out and taking some time out of your evening today to hear what we have to say. I feel like most of you hear us talk enough, so we really appreciate you taking the time to do so. Just before we dive in, a quick kind of overview of how this presentation is going to run. We're going to start with an update on the economy and the implications for the stock market from Dennis. We're going to review the Canadian election outcomes and implications for the stock market and portfolio. I'll go over that slide. We're going to profile a core holding we've held for most of our clients for a long period of time. That's Alphabet. Many would know it more as Google. Dennis is going to roll through that. And then we're going to look at a couple planning wrinkles that are very prevalent to our practice. One is asset location, which Dennis will speak on, and the other is annual year-end tax planning, which I will talk to. Then we'll do a quick questions and answers. We got 2 or 3 questions here from clients, and then some closing remarks and a thank you.
I guess the news, the stories that are going on that we're hearing about regularly, anywhere from, inflation. We've got supply chain issues. We have higher energy prices. We have problems with the Chinese real estate market. So I guess basically from my perspective, after 35 years in the business, it's kind of business as usual. There's always something that we have to be concerned about, of course. And it's just how we deal with that and maybe how we position the portfolio to make sure that given any type of economic circumstances, we may have some things that benefit and some things that don't. So let me address first sort of what's maybe caused the recent volatility, which, by the way, this time of year, sort of the last 2 weeks of September to through the first 2 weeks of October, is historically a very volatile time in the market, mostly because driven by sort of cost issues from institutions. So October 31st is the typical year end for most financial institutions as well as most mutual funds. So the institutional investor tends to do a lot of stock-driven selling this time of the year.
All right, so moving along, we're just going to talk quickly about the Canadian election outcome, like the implications for the stock market. Again, it's basically stayed status quo with regards to the Canadian election, where we have a Liberal minority. That's how it was going in to this election, and that's how it's kind of remained. So, from a stock market perspective, we really haven't seen too much changes, I guess, with, how people perceive this will impact things. Markets tend to like minority governments and outsized amount of power, basically, to be able to implement any kind of changes that they're looking to implement. I think it's safe to say the taxes will be going up. They've talked about, capital gains inclusion rates is one that gets thrown around a lot. Bank or financial institution surtax, and then additional kind of tax measures around the financial institutions.
So yeah, one thing, John, I'd like to add, I guess, is particularly around this capital gains inclusion rate. So that capital gain is what they refer to the inclusion rate is 50%, meaning you're only going to pay tax on 50% of the gain at whatever your marginal rate of tax is. So the discussion is around, should they increase? The Liberals are talking about increasing the capital gains inclusion rate. They want to take the number up maybe to 75%. Now, a lot of people would say that's a negative, and it's certainly unattractive for investors to look at saying, well, I'm not doing as well after tax. However, it's still the same issue is if I have a competing investment like low interest rates paying me little or no return, plus I'm taxed completely on the interest that I earn, versus only taxed on 75% of a capital gain on something that typically does much better, you're still further ahead, but it is sort of a conversation we have around, people say, well, it's very negative, and I just don't see it as, although it would be it's something I wouldn't like to see, it is something that could happen. And with all of the deficits governments are running, there is a likelihood that they're going to need to raise taxes somewhere. I guess I'll continue on here and we'll talk about Google. So Google's our focus stock for tonight. I'm sure, or Alphabet as it's called. I'm sure most of you are familiar with that company. It's primarily a digital advertising company is where they make the lion's share of the revenue. But they have so many things going on with that company that it's just unbelievable. revenues of approximately $250 billion in fiscal 2021. I know advertising revenue last year, I'll give you an example, was $180 billion. Was 145 billion, and this year it's going to be 185 billion approx. We look at digital advertising like this. If you took all of the advertising that was ever done in newspaper and magazines and television, it's all being amalgamated now onto your computer. And basically there's 2 or 3 or 4 winners in that scenario, and certainly Google is, if not the number one, it's in those top couple. So we continue to like it from an advertising perspective. So we're doing this all the time inside your portfolios. It's very important to us. We feel that this adds to the overall return of your portfolio. We think it could add as much as 1% a year as a return goes, as to not just what you own, but where you own it.
Something that's always going on behind the scenes, and it's a very large part of our discussion and the decision-making process. So it's just very difficult to quantify that to clients. It's something that we, talk about a lot, and how can we quantify it to you? But just know that there's a reason behind why we own certain stocks in certain accounts. Year-end tax planning. So we'll keep this short because we've touched on taxes enough already, and you're probably tired of hearing about it. But it's a big passion of ours, so it's something that we talk about a lot. So 2 things that we kind of always do as the year-end approaches, the calendar year-end, which is obviously year-end for personal taxes, is we're always doing realized gains and loss analysis. So this is applicable for people that have a personal or joint non-registered account, or clients that have a corporate investment account as well. So these are considered non-registered investment accounts. All that means is that income inside of these plans is taxable. Where, if you're in any kind of registered plans like a LIRA, RSP, tax-free savings account, for example, those returns are not taxed or preferentially taxed, deferred. Go into each client's individual non-registered accounts, analyze the holdings in there, which for the most part, they're usually the same holdings across, many of our clients. Weightings are a little bit different. Certain companies, not everyone has in their portfolio because of how they're rated from a risk perspective, but for the lion's share of companies, they're in all of our clients' accounts. So we take a look and say, look, are there any stocks that we're comfortable selling today to offset some of the gains that have been incurred throughout the year? Maybe there's stocks that we want to continue owning, or we think that it may kind of change in value in the 30-day superficial loss window. That's a discussion for another day. And then the second one is actually kind of the inverse of that, is annual registered plan deregistration. So this is more for the clients kind of, entering or in retirement. Basically, there's a bit of a window for clients before the age of 71 and even after, but less so. Certainly before the age of 65, where your income tax bracket in retirement may be lower in that time, especially if you've elected to kind of delay CPP, you haven't started receiving the old age pension yet. What we do is we look at clients with large registered plan balances, kind of in that age range, or, kind of situation dependent too. Let's say you're in between jobs or something like that. And we say, does it make sense to show a little additional income on these clients' tax returns? Just because, they're in a lower tax bracket than they normally are for whatever reason. And then based on that, like a lot of you know, we've had this discussion with you. And if you think you might be a candidate for this, please let us know. But, we do look very closely at people that we think kind of fit the mold for this. And, the final thing is we got to look at the pros and cons, right? So the pros are maybe you get some income out of your registered plan at a reduced rate of tax than you would in a normal year. The cons are you're foregoing some of the tax deferred or tax-free compound growth of the taxes that you pay early. So everyone kind of has a differing level of comfort with this. And it's something that, is kind of on a case-by-case basis, depending on your comfort level. So those are a couple things that are on our radar going into the last couple months of the year, and want you to know that are a real focus for us. There is a lot of negative news around the downturn in the markets. Is it time to reevaluate current holdings and move into more conservative options?
effort to sort of say, well, can we get to balance without, within equity ownership? And nowadays, because it's sort of like there's no alternatives, if you will, and you hear that conversation quite a bit, but the alternatives are just very low interest rates. It's not like back in the late 80s when Canada savings bonds or bank accounts were paying you 16 or 17% interest, that some of you might remember. By the way, 2 days from now is my 35th year in the business. I got licensed 35 years ago, October 15th, 1986. And it just seems like yesterday, but it's interesting to watch this cycle of interest rates and what's happened. And that's driven our portfolio allocations, certain areas, but always know that we're very cognizant, and we'll make changes that we think they need to be made. It's, we eat, drink, and sleep this every day of the week. And it's typically when family get-togethers happen, it doesn't take too long for the conversation to drift towards the economy or stocks or what's going on between John and I, for sure. And now, of course, we're trying to get Avery hooked. She's only 4 months old, but no sense in waiting. No sense in leaving the code too long. But anyway, so I'll leave it at that for now, John. That's I think that's probably a close answer to that question.
Just to say, we just want to say thank you very much to everyone who kind of took the time out of their evenings to listen to this. We hope you found it educational, informative. We hope it kind of offered you some peace of mind. I really appreciate all of your continued trust and support and business. It really means a lot to us. So thank you, thank you, thank you. Have a great evening, and hopefully we'll be talking to you all again very soon.
Night, folks.